between the different methods ultimately. We want to look at, and we're going to weight the methods. We're going to decide, okay, let's look at the market multiples method and see how comfortable we are with what the building blocks, which is a really important point. Valuation is only as good as the building blocks that you're using. Let the process take you where it takes you, okay? So, the market multiples approaches, we're talking about two different approaches here. We're talking about the trading and the transaction methods. The trading method is looking at the publicly traded companies. We've already looked at them, right, because they were what we used to calculate beta. You're going to land in a different place with each method. Here you're looking at a multiple of revenues or EBITDA or EBIT. That multiple is you reach an enterprise value. What did we say enterprise value means? Say again. Debt plus equity minus debt minus cash. To actually get to a net debt, you're taking a net debt plus equity equals enterprise value. And that's what you're basing your purchase price on, enterprise value. You can get to equity value just by subtracting net debt. Net debt is total debt minus cash, because the seller typically keeps the cash. Professional appraisers like to consult both methods whenever possible, but each method, including the DCF method, has limitations. So in some cases, you will not get comfortable with, in the DCF approach, you may not be able to get comfortable with just using a perpetuity growth method, is what I taught you today. You may not get comfortable with that. There's some example. Think about some companies like a startup company that has very little history and a rapid trajectory. It's going to grow to 60 million in 5 years. It's very hard to create a terminal value on that method. Okay, so we talked yesterday when I went through the 9 methods of the VC approach. That VC approach is taking an exit value, which I said was looking at a terminal value only and assigning and taking that. That is actually an alternative approach to the perpetuity growth method. Okay, and I'm going to quickly show you that back here in this model. So here in this case, this was a live client of Watermark's. You can see up here the WACC of this company was a range of 17.31 to 19.31. So this is a much higher WACC than what we had in the case study. We assigned, you see these multiples, the 1.97 to 2.40. Let's look and see how did we determine. This is an alternative again to that perpetuity growth method to calculate terminal value. And analysts really like this method as well. What we did here is we had trading comps and transaction comps, and we took in the transaction method, we took the mean or the average, and in the trading method, we took a median, which was more like a midpoint. And we took the two, and so notice that we're looking just at enterprise value to sales, but you could do enterprise value to EBITDA to come up with a multiple for your terminal value. So what I'm doing here is I'm taking a midpoint of these two numbers, which is 2.19. And I'm moving that over here to make it basically a multiple that I'm going to multiply by the last year of the concrete period's revenues to get to a terminal value. So I take the 2.19 times, in this case, I took sales of 9.7 million, and I get a terminal value of 21,290,000. And then I go through that exercise you just went through to present value that back to time 0. Okay? So I'm taking that, and I'm creating a range. This is just plus or minus 10%. Okay? That's different in every case. You don't have to use that. But again, I'm basing this multiple off of the comp method, and I'm using this, I'm multiplying it by the last year's revenues to get a terminal value, and then I present value that, and that brings me back, the midpoint is 9.1 million, and I add that to the free cash flow, present value of free cash flows, and the midpoint of this valuation is about a 10.8 million. Does that make sense? That's an alternative to what we did late in the morning to that perpetuity growth. Those three calculations we did, the return on capital, and then the reinvestment rate. This is an alternative to that, and it's a very credible alternative. Okay? I just wanted to deviate for a second and show you that. So let's go on to the next slide. Sometimes you can't find a reliable base of publicly traded companies, or you may not find a good set of recent transaction comps. Maybe there were a lot of deals in that industry, but they were 5-10 years ago. Not too happy about that. We want to leave those out because that's a different economy, different market conditions. You don't want to go too far back in time. I say last 5 years typically is a good range of time to look for M&A deals. Do you remember what I said yesterday about picking publicly traded comps? What determines what makes a good comp of a publicly traded comp? There are two things I'm really looking for. Revenue overlap, and what does that mean?
Well, that their percent of revenue is in that area is about the same.
So of the company that you're valuing, the comps you pick, you want to pick comps where these comps are all going to be public, so they're going to be large companies. And so let's say the comp you select is 100 million of revenues. You want how much of their revenues are tied to similar products and services to the subject company you're valuing. You want that to be ideally 50% or more. You don't always get that. You're going to find a lot of public companies have diversified revenues, and I will throw out a comp if it's, I'd say, less than 30% typically, overlap. Does that make sense, the overlap? And then the margins are important. You want to find companies, the public comps, that have similar margins to the subject company. If the margins are really different and it's a much larger company, that may mean there's some noise in there that you're never going to be able to cut through, and it's not a good comp. The size of the company, and I often get this, well, hey, this comp is so much larger. I know we had this in this case earlier, but I'm assuming they got rid of that large comp for a different reason. But the size of the company can be adjusted as long as it's a good comp. We're going to talk about now the adjustments for what we call discounts and premiums. One other thing to think about when you're coming up, if you're using the multiples approach to determine terminal value, or even just the market approach to comps, is multiples change over time. Both transaction comps and trading comps, market conditions change quickly. So if you assign if you are determining terminal value based off of a market approach, that multiple approach, and basically what you're saying is in 5 years, this multiple is going to be a good multiple. But who's to say that? Because multiples really do change. We base that terminal multiple off of trading comps and transaction comps, which are today and in the past. And then you're going out 5 years. That's why I don't love that method because of that reason. Because you're bringing things into the future that really becomes more speculative at that point. So the conclusion is that there's a lot of judgment about terminal value, and terminal value has a lot of impact on the value that you're going to come up with, the final value. And you've got to be careful and thoughtful of that. Be sensitive to the judgments you make in terminal value. Let's talk about discounts and premiums. So now I think, I'm assuming we have, one second. Let's now look at the valuation of mercury. If you get out your case, look at the exhibit with the comps. What exhibit is that? Go to the trading comps. 3. 10. Page 10. So we're going to value now mercury using the trading comparables method. Okay? We're going to base it off of EBITDA. And we're going to exclude Victory, even though it's questionable. Maybe it was a good comp, but we're rejecting it. So we're only going to look at the remaining comps. And what we want to do is come up with a multiple based off of these comps. So let's go through that exercise. We're going to be looking for an average EBITDA based off of these publicly traded companies. So run through that calculation, and when we're ready, we'll talk through it. So you're going to use the EBITDA of mercury, and you're applying that to a multiple that you're concluding off of these comps.